each year in your budget set aside 1% of your total home value for repair and maintenance in future. Home ownership includes more expenses than just insurance, taxes, or utilities. There will be things that will require repair, things that will break down, things that will depreciate and will need maintenance. And hence you will need to constantly upgrade your house, and this will require and incur some expenses at your end. So this 1% rule will cover you against those expenses. Now note, this is just a rule of thumb and may not apply in every situation. Just as an example, the expenses that you may incur will depend on the age of the house. The older the house is, the more expenses you may end up incurring. So accommodate for such factors. Coming to rule number 4, put at least 20% in down payment when you're purchasing a house on mortgage. What it does is 2 things. 1, it limits the amount of money that you will borrow, which will ensure that you don't end up buying a house which you can't afford. Hence, it will also reduce your monthly installment payments. Secondly, in case of at least North America, it will ensure that you don't incur an additional cost of private insurance, which is required when you're putting a down payment less than 20% of the total value of the house. Rule number 5 is to consider refinancing your home if the mortgage rates drop by 1% or more. Here the rule is actually the word consider, because refinancing will depend on case-by-case basis. It depends on how long you plan to own the house. What is your current mortgage rate? What is the cost of refinancing, that is the penalty cost involved? All of this will determine whether you should refinance or not.